Hi there, Stuart Williams here from Thirlmere Deacon. Today I've got the pleasure of sitting with Senior Associate from Knight Frank Finance, George Jones. George, please say hi.
Good afternoon, everyone.
What I like to do is sit with our partners as much as possible to be able to deliver their expertise directly to our investors. Okay? I've got some entry-level mortgage questions today. George, are you happy to run through these with me?
Most definitely, Stuart.
So, with the market the way it is and the economy doing all sorts at the moment, what sort of mortgage rates are you seeing on average?
So it really depends, Stuart, on a couple of things. Number one, whether the mortgage will be held in their personal name or it will be held within a limited company. If we're looking at the leverage as well, the leverage will also play a part. Okay, so for example, if we're looking at maximum leverage being 75% within your personal name, then you're probably looking at around about 3.68%. Whereas if it's held within a limited company, you're probably looking at slightly higher, around 3.99%. If we reduce the leverage down to 60%, which is where we start to see the best interest rates available on the market, then you're probably looking at around about 3% flat.
Fantastic.
I'm going to start that good afternoon one as well.
That was good.
Yeah.
And then what do you see happening in the future with interest rates?
I think, we've been spoiled definitely with a lower interest rate environment for a long period of time. The base rate being 0.1% for the best part of a year played a huge factor. So people looking at mortgages now in comparison to say a year ago have seen a vast difference in interest rate. Now naturally that's due to the base rate increasing. So we're now at 1.25% from 0.1%. We've had 6 consecutive base rate increases, which is unprecedented, right? Inflation within the UK is at a 40-year high. And that plays into the reason why some of these interest rates carry on creeping up, okay? So the main reasons that we're looking at interest rates increasing in particular to curb inflation, is caused by high energy prices, high interest rates from the bank, the cost of raw materials. So when you see your developers, which I'm sure you've had conversations with, it's costing them more to make these developments. Cost of food, the overall cost of goods is increasing, especially correspondent to income. So I think short to medium term, with that in mind, interest rates will increase to curb that inflation. Once we get that inflation down to suitable levels, then I would say that interest rates would then start to stagnate. Okay, I think by the end of this year, maybe Q2 next year, we'll start to see a stagnation in interest rates. If we can get the inflation rate down to around about 2%, then we'll start to see interest rates stagnate.
Some of the more common questions we have from expat buyers are, look, if I'm based outside of the UK, can I still get a mortgage here?
Definitely. In fact, most of my client base tend to be foreign investors. Now we can class foreign nationals or people based outside of the UK within 2 categories. One being expats, so people living outside of the UK being UK nationals, and foreign nationals in general, so non-UK residents and non-UK domiciled clients. In both of those instances, mortgages are achievable. Okay. Now naturally each lender has their own criteria and options are more restricted, but there are still good options nonetheless.
Superb, okay, that's actually really helpful.
Just to add on to that, and again you can add this in. So when we're looking at foreign national and expat mortgages, there are a few additional nuanced bits of criteria which enable the lender to consider this case. So the lender may look more into the client's income. For example, some lenders have a minimum income requirement of say 75,000. They'll also look at the client's experience, previous experience. Have they let a property in the UK before? Okay, are they experienced and know what they're doing? And from a third aspect, they'll also look at where the client is based. Is it a high risk jurisdiction? So there's a few bits that I'll need to discuss with the client in order to recommend the most appropriate lender.
Okay, so in essence, most cases, there are options, but all cases are on their own merit. Exactly.
So, each individual lender has their own criteria, and where I deal with over 100 lenders, not only is the bank assessing the individual from a criteria aspect, but they're also assessing the property in which that client is looking to buy.
And how long does it take to arrange a buy-to-let mortgage, in your experience?
I think that's a great question, Stuart, especially with the off-plan properties that you've got at the moment. It depends on whether the client is based in the UK or not. Naturally, because if clients are foreign nationals, they would need to open a UK bank account alongside their mortgage facility. That can take a little longer than, say, a UK resident that can proceed straight away and already has a UK bank account. But in real terms, I would say that we're probably looking at between 6 to 8 weeks, generally speaking, in order to arrange the mortgage.
And following on from that, how long does a mortgage offer typically last for?
So mortgage offers typically last between 6 to 8 months. And when I say 6 to 8 months, generally speaking, it's 6 months, and then we can look to gain an extension for up to say 3 months, depending on how well progressed the legals are with that particular development.
So as you know, George, we work with a lot of off-plan property and we recommend those to our clients as the best way to invest. But with an off-plan property, what's the best time to start looking at an application?
You know, definitely, I've seen a lot of my foreign investors that have invested in off-plan properties have generated a good amount of appreciation in their property value naturally, and that's through the market increasing whilst they've already got a price agreed on their property. So, you know, some clients can do contract reassignments, for example, if they see the market increase and where a property's built 2 years previously and the market significantly increased. But generally speaking, I would say that we need to start looking into the mortgage 6 months in advance. Okay, because as we've discussed, you know, you've got the mortgage offer that's valid for 6 months. Ideally, I'd like a month or so to conduct my research and present the options to the client and make sure they're happy with things, so that, you know, as the mortgage application takes between 6 to 8 weeks, we've got enough time, we've got ample time to get the mortgage approved and the finance secured.
And the last thing you want really in this situation is to be rushing around to try and satisfy the bank's requirements.
In the current market, it's crucial, not just from the point of having all of the documents to hand, rushing around getting these documents. It's also crucial and beneficial to the client, especially in the current interest rate environment that we're in. Interest rates are increasing constantly, okay? So the quicker that we can get an application secured and submitted, that's when the rates are secured. Right. So it also benefits the client from that aspect. Another
really popular question we get from our investors is it possible to use equity from my own home for buy-to-let investment?
Yes, definitely. I would say that it's quite common amongst first-time landlords that have a significant amount of equity, maybe in a property that they've owned for many years, and they're looking now to, you know, broaden their investment types. Okay, whether they want to invest in bricks and mortar or elsewhere at that.
Just expand that portfolio.
Exactly that. You know, they've been in property for 20 years. They've got a low mortgage, a good property value. They now want to start to reinvest that money which they've earned over those years. Okay, now, it really depends on the amount of equity in your property. So your property value minus the mortgage that you've got outstanding. So if we've got a property worth, say, 500,000, and you've got a mortgage outstanding of 200,000, we could raise roughly 85% of the property value. So let's say 425,000, which after we pay your mortgage would give you roughly 225,000 then to invest in another property. Now that 225,000 can go towards the acquisitional costs, including the actual acquisition itself. So when I say acquisitional costs, I'm referring to stamp duty, solicitors' fees, you know, all of the above.
So with the figures that you just mentioned, there's quite a healthy deposit to cover all the purchase costs. So deposit, stamp duty, all the legal fees, you can take it straight out of your own home.
Correct, and in some instances, there's no requirement for an onward mortgage. You can purchase property with cash. So I know some of the properties, for example, on the figures that we've discussed, you may be able to purchase property with cash, you know, for 200,000, 225,000, and what you tend to find is that these properties that are slightly lower in value would also have a greater rental yield.
Another question is it true that lenders require rents to be 125% of the monthly payment?
Yes, so I mean, it's more of a stress testing ability than monthly payment as such. But that stress test depends on the transaction type and also the client's tax liability. For example, if we're looking at a limited company buy-to-let purchase, it's 125%, usually stressed at either pay rate or 5.5%, depending on whether the client is opting for a 2-year fixed rate or a 5-year fixed rate. The lender will always give a more favourable stress testing for the 5-year fixed because the lender will always give a more favourable stress testing to the 5-year fixed, as the client will have a longer period of stability and security in their monthly payments. So effectively speaking, you know, the client can borrow more by choosing a 5-year fixed rate. Now this is more common, I would say, within the central London market because rental yields aren't as strong. Whereas some of the properties that you're looking at outside of London will have a much stronger rental yield, which I would say gives the client a greater flexibility to look at either a 2-year fixed or a 5-year fixed, whilst also maintaining the maximum leverage that's needed. Now, when we start to look at personal mortgages and personal buy-to-let mortgages in particular, the same rules apply, whether it's a 2-year fixed or a 5-year fixed. But also it depends on the client's tax liability. So generally speaking, as we've discussed, it's 125 at pay rate. However, if let's say, for example, there's a client earning 50,000, which is a higher tax banding, instead of the mortgage being stressed at 125, it'll be stressed at 145%. So say, for example, we've got a property worth 300,000. we can rent that property out for £1,000 a month, okay? On the lower stress test, so let's say that the client's a lower rate taxpayer or they're purchasing the property in a limited company and it's a 5-year fixed, 75% can be achieved, okay? So, you know, the full 225,000 can be achieved. Whereas let's say, for example, you're purchasing the property in a personal name, okay, but you're a higher rate taxpayer and you only want a 2-year fixed, roughly speaking, only 60% of the property value would be able to be achieved. Of course, that depends on the rental yield of that property.
And then another question that we have quite frequently is, how do banks generally assess an application? What's important to the bank when looking at a buy-to-let opportunity?
It's all about risk, Stuart.
Yeah.
It really is. So when I say risk, I mean risk in the aspect of the applicant. So do they have income? If so, how much is that income? Where do they reside? Okay. Do they have any previous experience? What type of client is the bank dealing with? Okay. But risk is also assessed from the aspect of the property type. Is the property a new build? What types of warranties are available on this new build? What is the build time? What are the specifications of the property? Both of these elements combined is what the lender will use to assess the client's mortgage application.
George, thank you so much for your time today. Great answers to the questions, and I'm sure we'll have more, so we can do this again another time, yep?
My pleasure, Stuart. I look forward to it.
Perfect.